In today's video, we are going to talk about using a whole life insurance policy to pay off student loans. What we're going to look at during today's case study is a doctor who currently has student loans of about $350,000, and presently he's paying interest only. So he's been looking into whole life insurance and said, what if I use a whole life insurance policy to do this? What are the drawbacks? What are the benefits? And how does it make my life better now compared to what I am already doing? So we'll go over the mechanics of how this works with an actual policy to see if it actually makes his life better. So how it works at a very high level is, here's our doctor. He's got some money. He's going to put it into a whole life insurance policy, and he's going to see that the cash value is going to grow by a little bit more than 5% per year. Now, his plan is to then use it via a policy loan. So we'll take a loan against the policy, pay off the student loans. Here's why he's going to do this: because he still gets that 5% on the money that he's pulled from the policy. So it keeps on earning interest for him. Now, he also has a cost to borrow. The loan interest rate will be 5.1%. But I'm going to go over the growth rates and show you all the numbers, don't worry. So a high level of how it works, here's the plan. I want to fund a policy with $100,000 per year for 10 years. The reason why is because this lets me move a total of $1 million into the policy, and I really like the cash value. This is why I'm doing this. When I look at the cash value, it's a safe place to put money. I can access it anytime I want, and I'm going to access it to pay off these loans. And also, it's tax-free, provided you, Steve, the agent, do everything right and make sure I don't violate any IRS rules. So he likes it primarily because of the cash value, but it also gives him life insurance, which he does have a need for, and he wants to make sure that he's got that. But the focus will be using this policy to pay off his student loans. So what we're going to look at is as follows. First, we've got growth. We'll see what the policy looks like if he doesn't take any loans at all, which I recommend always look at this in terms of a starting point. Because the first thing I want to focus on is how to maximize the cash value. Because if I maximize the cash value, what does that mean? I then have more cash value to go out and use to pay off student loans, or use it for whatever I want. Where people have buyer's remorse is rarely about loans. It's always about finding out that their policy was not maximized. Then what we're going to look at, a $350,000 loan, but never paying anything back. So what does it look like if I don't pay it back? I don't pay any loan principal or any loan interest. Then what does it look like if I pay interest only versus paying interest until I'm 50, which is the end of the 10-year term, the 10-year funding period, and then I start to pay back the principal. What does that look like? So let's have some fun, and we'll start with the illustration. So what we've got here is a policy where he plans on funding $100,000 per year for 10 years. First item I want to hit on here. When you see this $100,000 going in, do you think that you're billed for this every year? Meaning, are you required to pay this? And if you don't pay it, the policy will lapse. No, that's not the case. Up here is your premium, set at 10%. Then we've got a term rider attached, but the majority is going toward PUAs. Add everything together, we fund $100K per year. If he says, I had a slow year, do I have to pay in that 100? Can I just pay in 20 or just 10? The answer is yes. We can easily take our foot off the gas and scale that payment down, and then we can scale it back to 100 and even make up for lost time later if we want to too. But looking at this, cash value looks great overall. First year, you're at 90% of what you paid in. You paid in 100, you've got 90, and you're cash positive by year 4. Okay, so that looks good. Let's take a look at the loan models, shall we? So first, we'll look at this growth model again, but with the net returns. A lot of people like to look at this, including myself. So this policy is with MassMutual. The dividend rate is 6.4% for 2025. That's the dividend used in this illustration. If you have a dividend of 6.4%, do you think your cash value would grow by 6.4%? A lot of people would think that. It's common sense would tell me that. It's not the case though. Dividend rate is a gross rate that is applied to our cash value after the company's insurance expenses, mortality charges, everything that comes with the life insurance policy. So if I just want to see the bottom line, there's two things I can look at. One, my annual ROR, which stands for rate of return, or my internal rate of return, which is a fancy way to say the average growth rate over time. So looking at the annual rate of return, that peaks not at 5%, but a little bit more than 5.5%. And if we look at the internal rate of return, that does get over 5% as time passes. But those are our net growth rates when we look at the policy. So that's important to see if you like measuring the rates and specifically comparing what you're getting in terms of an annual rate of return or an internal rate of return versus what you're paying in loan interest. Some people like to do that. Some people prefer to compare it via dollars. But there's the illustration, just growth. When I take out loans, you get the same growth. Remember, with the policy, your money keeps compounding when you borrow against it. That's why he's interested in this. So, option one, what if I take a loan and don't pay anything back? Well, here we go. So, what we've got on the left is the growth illustration. On the right, loan and no payments. When does he take that policy loan? Policy year 4. So he uses that, pays off his student debt. He is in the clear and he feels a whole lot better. So he doesn't have that hanging over him anymore. And also understanding that he's got complete flexibility to address this loan however he wants. Feels like a burden's been lifted. Now when that 350 is pulled, what's it pulled from? The cash value. The cash value is the gauge that determines how much we can borrow, just like a line of credit against your home or piece of real estate. So when you pull that $350K loan, I should say before you pulled that $350K loan, your cash value was $407. After you pulled it, now your available cash value is a little bit less than $40,000. Your death benefit before you pulled that loan was about $2 million. It dropped by exactly $350,000. So both the cash value and death benefit are impacted when a loan is taken. From the insurance company's perspective, they're saying if you take this loan and you die, it's going to be reflected in the death benefit that's paid out. Now, if you don't pay it back, what happens? Here's your cash value. There's your loan interest. Loan interest, $17,850, is not paid in this example, so it's added to the balance. If you don't pay the loan interest, it will compound. Now, what I want to look at very closely here is this. Year 5, I paid in 100. I was at 39, now I'm at 139. So the policy was able to cover the loan interest, and that's about it. It's just about a wash in that year. Meaning, if I didn't have that loan interest due, I'd see the cash value grow very close to $17,000 and change. In fact, you can see that over here on the left. Let's look at it this way. So that's what, year 4 to 5? Check this out. There you go, $18,000 and change you would have seen in total growth if that loan was not existent. So you're still getting that growth, but the loan interest is masking it a bit here. Now, as time passes, loan interest keeps on compounding. However, your cash value does too. And the cash value is compounding at a faster rate than what the loan interest is compounding by. And how you can see that, just to simplify this, look at year 20. How much did you pay in? 1 million. How much did you take out? 350. So what's the net that you paid in? It'd be 650. That's my total input as far as dollars that I paid into the product. Okay, so 650 in, and by year 20, I've got 1.28 million. And then it just keeps on compounding as time passes too. A lot of times individuals look at that and say, hey, if I don't have a desire to pay back the loan, I'm still seeing positive cash value growth over time, which is attractive to them. Now, quick side note, if this loan was 80 or 90% of my total input, that's where I might run into an issue where I would have to come up with something out of pocket. Otherwise, the policy might lapse, and that can trigger a potential taxable event as well. Let's progress on to paying interest only. So here we go. What do you notice here? Same thing on the left in terms of growth. The difference is after this loan, in light blue, you've got your loan payment. That loan payment matches the loan interest every year. So as the loan interest comes due, we're assuming you pay it. And what you'll notice here is that cash value and death benefit is always going to be about $350,000 less than what you see in the example where you never touched it. What that means is if down at year 20, say he worked at a medical practice and he was a partner and then he had an exit, he had a big liquidity event, and he said, hey, can I just pay off this $350,000 loan? The answer would be yes. And if he paid it off, the value would be restored to what it would have been as if he never touched it in the first place. So again, this is why he's interested in using it to pay off the student loans. Okay, last example, which is most realistic in his particular situation. Borrowing and then repaying. What do we see here? 100K per year for 10 years. Over here, there's your loan. Now in this example, what's he doing? Paying interest only through the 10th year. Why? Well, during this period of time, he's still funding the policy. So to fund it and aggressively repay the loan was something he looked at and said, that's just going to cause me stress. I've got kids going to college. Like, I don't want to have to do both. Can I just pay interest only and then start to attack the loan later? Yes. You could even pay nothing. The loan would compound, but you could pay nothing and then begin to attack it later. You could do the same thing. The net effect will be the same at the end of the day, in the sense that once that loan is repaid, your cash value and death benefit are going to be fully restored to exactly what they would have been as if you never touched it in the first place. So using the policy to pay off the debt allows him to see his money continue to compound as the years pass. He can use it to pay off those loans. If they're higher interest loans, it's a no-brainer. If they're lower interest, it might not make sense to do this. We would measure the true cost to borrow over time. But that's the advantage to it. And the disadvantage, there's one clear one, which you may have picked up on, which is before I even look at loans, I've got a negative hit in the beginning of about 10%. That's the clear drawback, where I'm taking a loss initially. The other drawback is somewhat in his control, has to do with how quickly he decides to pay that loan back. For example, if he said, hey, can I not pay the interest here and just let it defer and then attack the loan later? The answer is yes, but when you eventually start to attack it, you're going to find that you're going to pay more in loan interest because it's compounded. So your net cash value and death benefit will be the same. However, you would have paid more interest now. So that'll drag the net return, if you want to look at it that way, down a bit. But still works out in his favor, where he's got significantly more in cash value than what he paid in. The earnings he received are significantly higher than the interest that he's paid, And a big reason why is because he put in $1 million and he borrowed at 350, so it's 35% of what he paid in. Of course, it's going to look good. But with that said, I hope you enjoyed this video. If you have any questions, comments, or thoughts, please feel free to leave them in the comments below. You can also DM me if you'd like to connect. Would love to talk with you about all things cash value life insurance. And as always, I hope this helps. Thanks so much.